What's up investors, this is Chris. Welcome back to my channel, and in today's video we're talking about 3 dividend stocks to buy, 3 of them that I personally own that makes up almost 20% of my portfolio, and they're very diverse stocks. So if you're excited for this and you want to earn some nice big dividends too, make sure you stay until the end of this video because there will be a ton of knowledge and research that goes into this. Without further ado, let's get started. So before we get into the companies, let me explain just very briefly some key terms that you need to be aware of for this video. So annual dividend is the total amount that the company pays per share that you own over the course of a year. So if a company has a $3 annual dividend, that means they pay $3 for every 1 share that you own. So if you own 10 shares, that will be $30. If you own 100 shares, that will be $300. So you can see the more shares you have, the more money you're gonna get. As far as dividend yield or dividend percentage, you might see, that is the percentage that dividend is, so like that $3 I just mentioned, as a percentage of the whole share price. So if a company is $100 and they pay a $3 dividend, their dividend yield is 3%. Some stocks are going to have higher yields and some stocks are going to have lower yields. The higher the yield is, generally the consensus is the more risky that investment is. A company that is paying that much out of their net income as cash to shareholders as dividends, because these are deposited into your stock account and you could reinvest with it. You can decide not to reinvest with it. It's up to you how you want to use it. But if a company has like a 10% yield, a 15% yield, a lot of the time if a company has a really high dividend yield, that means the share price is not doing that well too. Because let's say normally that share price is $100 per share, it pays $3 in dividends at 3%, but if the stock crashes to $50 right now, the yield on that would be now totally different. It would be much higher. It could mean the business is so bad the stock price won't recover, and obviously that's not a good investment, not a long-term investment. Usually you want to see a company have a track record of consistent dividend growth. So every year they're going to increase that dividend amount. And if you wanted to look into the health of this dividend company and whether or not it can continue to pay that certain amount of dividend to you, then you want to look at something called the payout ratio. So the payout ratio is a percentage of the amount of money the company pays out as dividends divided by their net income. So if a company has a payout ratio of 100%, that means they're paying out all their income to you as dividends. And that might sound great and all, but that's actually not a good thing for the health of the company. The company is paying everything it has back to shareholders, then essentially that company is like just it's like an empty box, so to speak, right? There's nothing that's keeping it. Everything that's going in is coming back out, and again, that's not good for the health of the company, not good for the long term. It really varies by industry, it varies by the fundamentals of the company. So the first one we're talking about here is O Stock, otherwise known as Realty Income Corporation. This is a dividend aristocrat, meaning they've been paying out that dividend and increasing it for decades. Okay, a very exclusive club. And as I mentioned earlier, most companies pay a quarterly dividend. So every 3 months, they deposit that money into your account. The beautiful thing about O Stock is that it pays on a monthly basis. So what that means is, for this company specifically, if you own the stock at the end of the month, they will pay out a dividend to you 2 weeks after that. So the middle of the following month. And then they keep doing that. So they have a nearly 5% yield, 4.6%, and they pay that every month. So you divide that by 12 and you get a monthly percentage of what you're going to get. In the case of O Stock specifically, they pay 23 cents for every share you own per month. So if you take a look at my history here, I have 150 shares and I get about $35 a month from this. And if you kind of think about it from a long-term perspective, if you happen to be a wealthier individual, if you happen to be focusing on retirement and passive income as well, then obviously if you have more shares, you're going to have a lot of passive income coming in. You know, if you had 1,000 shares, if you had 2,000 shares. And for some people, this is an interesting way for you to get passive income from real estate without actually owning real estate. You're essentially a shareholder of a holding company that has tons and tons of assets, thousands of properties, over 6,000 properties, and they rent them to big box corporations. They rent them to Walgreens, they rent to Dollar General, a lot of convenience stores, and they are the landlords here. They collect the rent from those big corporations, and they use those funds mostly to pay back out to shareholders. So around 80% or so of the funds, and the remaining amount, they use that for upkeeping with the assets, right? The properties, and they have tons and tons of assets, right? Valuable properties, and they're also expanding. So on top of the money that's left over, they're also going to raise funds now and then to buy more property. With dividend stocks, I want that really nice track record, and to make sure that they're gonna keep paying me and keep paying you guys. But the other thing I really like is that those companies still have growth prospects for it. So with O Stock, they still have a pretty nice growth perspective because of that expansion to UK. They're constantly funding new properties that they rent out. By the way, they have a super low delinquency rate. They have a really high occupancy rate, so they're constantly getting that money coming in, that cash flow, right? Shout out to Mr. Wonderful on CNBC Shark Tank. He always talks about that. But with all that cash flow, you can keep running that business so smoothly and doing so many more things to add value to it. And they also have a really nice balance sheet as well, really strong asset to debt ratio. So they have over $20 million worth of properties. They only have $8 million of debt, and they have a really high credit rating, so it's a really low interest rate type of debt. Now, the one thing that is not good with O is that about 10% of the portfolio is in troubled industries, and that's going to be theaters like AMC. It's going to be fitness and gym, and other related type of entertainment venues, which are not at full capacity or not open at all in some regions. So once that comes back, though, that is something that I like again, right? That opportunity to recapture that revenue and that growth, or even let's get rid of those guys and rent out to some other better people in the future if some agreement can be reached. The stock right now is kind of in a consolidation period. It's been $60 for quite some time, and I really like that because it obviously gives you a chance to load up, gives you a chance to get in before that share price appreciation that I do expect to happen in the future. Overall, this is a very solid stock that you want to own in your portfolio. Stock number 2 on this list of dividend stocks is Dow, D-O-W, otherwise known as Dow Kapow. And this is a $57 stock that pays almost a 5% dividend yield again. And this is in a different space totally from O Stock. This is a basic materials company, and a lot of people don't actually invest in companies like this because it's kind of boring, right? It's kind of related to commodity, oil, plastic, right? But these are basic materials that are needed in industrial manufacturing, whether it's plastic packaging type of products. People have been snacking and buying stuff a lot these days with the pandemic, and even before the pandemic, right? This is something that we just need. And you have automotive parts as well, silicon. So this is a very basic type of company, but a very important part of our society. And to not just focus solely on the idea that it's only connected to oil, they are really heavily investing right now into renewable type of materials. They're investing in recycling and recyclable type of products. So it's almost kind of like a blend of a fossil fuel type of company, but also trying to get into some green energy future type of plays here. And this is a company that is really well run by the CEO. The dividend is very safe. Over the past year, they've paid off hundreds of millions of dollars in debt, and trying to really streamline and bring down costs too as a result of the pandemic. And the CEO has gone on record many times and said that the dividend is very safe and it is a priority of the company. I recently bought back in around $52, $53, and we're up about 10% there. It's been a pretty great investment so far. All right, so this company pays 70 cents per share, and this is a quarterly dividend, okay? So every 3 months. Again, you can see here some of the dividends that I've gotten over time. A lot of people are expecting that after we get out of this pandemic and we've gotten out of this recession and we're starting to build up that bull market and bullish cycle in the real economy where manufacturing is going to pick up. If we get an infrastructure bill, that's going to really drive growth as well and earnings as well. So at a 5% yield, I think this is really solid and they can continue to pay that out. I think you could be seeing a pretty significant dividend increase in this company in the near future. One of the big reasons is because next year analysts expect that the profitability is going to spike back up 2 times. So double the amount of net income that they did last year. Not to mention, as that profitability increases twofold, you're going to see that valuation come down, and I really love the forward PE ratio of 16, okay? The average in the stock market right now is well in the 20s. So a forward PE of a 16, and in this type of industry as well, where normally PE ratios can be quite high, I think that there is a lot of room in the stock price as well to grow. And by the way, guys, if you could do me a favor, please like this video and comment down below if you own any of these stocks yet that we're talking about, O stock or Dow stock. Third stock is JP Morgan, and this is a $140 stock. It's quite expensive, you know, one of the more expensive ones on the list. But this stock has a lot of value and a lot of really good things that I think dividend investors need to pay attention to right now. So normally, JP Morgan Chase, this is a bank, the biggest bank in the United States, increases their dividend very often. But due to the pandemic, right, because of concerns that people are going to default on their loans, their mortgages, they're not actually depositing and putting much money into banks. Perhaps people might need to withdraw a lot of money to pay bills and whatnot, that they've been forced to not increase dividends, even though they have a ridiculous amount of cash on their balance sheet. They have a ridiculous amount of assets. They have a very strong, you know, growth during these times. Despite the pandemic, these earnings have been phenomenal, you know, record earnings quarter after quarter. Over the next couple of years, as interest rates rise once again, they are at some of the lowest levels we've seen over the past, you know, decade, right? But they are going to obviously be able to make more money off of people's deposits. You know, the way a lot of banks make money is that you deposit money with them, the bank goes and takes that money because they don't need to keep it all in their accounts. It's just going to sit there. So what they do is they buy treasuries, they buy bonds, things that give them yield, right? It's kind of like they take your money and kind of find something to get more money with it. Over time, we're going to see that interest rates will start to pick back up because of inflation and all the money in the markets. So as it gets to, you know, let's say 1.5 to 2% this year, perhaps, as it gets to 3% at some point, most likely in the next, you know, we'll call it 3 years, within 3 years, I think, banks are going to have more income. So you're kind of getting in at a low price now, kind of at the trough of the business cycle when it comes to banks. And as we get those better earnings and we have a clearer picture of the consumer health and a clearer picture on the amount of people that are actually gonna, you know, default on loans and how much banks are gonna take as a loss, I think it's gonna be a lot lower than what people expect. Then banks are gonna be able to get freed up to increase those dividends, and they've already been green lighted to increase and be allowed to do share buybacks. Lastly, on a valuation metric, JP Morgan trades at a trailing price to earnings of around 15. The forward price to earnings is around 12 or 13. Very, very low valuation again compared to the rest of the market. I think that the real fair value over the course of the next year will be around $180 per share. And the dividend right now is around 2.7% or so, if I'm not mistaken, which is very solid for the growth that you're going to get. All right, guys, with that being said, that is the top 3 dividend stocks in my portfolio and stocks that I recommend you buy. Let me know in the comments down below if you are invested in any of these, or share some other dividend stocks that you are aware of. Maybe some people might want to do research on them. Maybe I might want to do research on them as well. We'll see, right? But until next time, my friends, stay well and invest responsibly.